Good afternoon and welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle.
John, I'm here again.
I'm glad you're here too.
This broadcast, by the way,
we recorded for future use.
well,
They
when
major just like the coronavirus here. Depends on who you are. And
locally, Bush did Lacey Clay, a 10-year term congressman and actually a legacy.
I think he finds that a hiccup.
We are inching closer to opening day for schools, around which there is a lot of anxiety and uncertainty. But despite social distancing efforts, several Cardinals players and staff contracted the virus, so play was suspended. I spoke with a local bank president last week who said that small businesses are still fearful, and we will likely see more and more bankruptcies. And at the same time, Republicans and Democrats have yet to agree upon a new COVID relief bill. So with the extended or the extra $600 week of unemployment benefit expired, some expect a contraction in consumer spending. And with all of this, amazingly enough, the S&P 500 and the NASDAQ are actually positive for the year.
NASDAQ has made new highs.
That's remarkable. And the Dow Jones Industrial Average and the international equities are still negative. So, Aaron, what do you make of all this?
Well, I'd love to get in here and we can discuss some of that. So thanks, John. We continue to progress through the economy, though there's certainly a lot of concerns. And we're not saying that everything's great, but we have just been progressing. We've watched that data that we continue to monitor to continue that to show recovery. We continue to see a drop in new cases nationally. The peak was really 3 weeks ago, if you look at the numbers, and we would not be surprised if we saw an acceleration of these dropping off. A lot of the testing and the ramp up, if we really are getting a real decline in those new cases, we should see this actually accelerate on a downturn. So we'd be happy to see that. Obviously, we're going to continue to watch the data just to see what happens. We've continued to compare this as a lag, so the new daily deaths versus the new cases, and we're still seeing elevated daily deaths. We believe this decline is going to happen, but it's probably over the next couple of weeks. When we looked at the information today, so this is information from yesterday, we did have a spike. Now, if you look back on Wednesday last week, that yellow bar in here, there was some reports from Texas that were from a previous day. So it's not an apples to apples comparison, but usually Wednesday, Thursday numbers are really similar. So we expect a slightly higher 7-day average over the next week. And then that's when we expect to see it peak and start to drop down. Nonetheless, there was about a 4 or 5 week lag from the new cases turning into an increase in new daily deaths. So maybe we'll have a little bit longer lag here. We think that lag was really more due to all the new cases coming on relative to the spike that was happening,
Right.
But not to the extent of the new cases or the new tests coming online. Here are the states that were increasing, those hot spots last week. And here they are this week. Notice that there's a lot less states here this week for those that are increasing. So that continues to show that we as a nation are beginning to have that downward movement from the quote unquote second wave. If we look at the states that were the same from last week and then compare it to this week, yes, there's a slight increase, but it's nowhere near the amount that you would expect considering that decrease on those states that were increasing. I know that's a little confusing, but what I mean is there are a lot of states that are moving into the decreasing camp. And look at some of these names right on here: Florida, Louisiana, Arizona, Texas, South Carolina. Let's go back a few weeks ago. These were the states where that hotspot was were showing up in the headlines. Now, it's not just the U.S. that is experiencing second wave. The U.S. has got a lot of criticism from that second wave, but Europe is now seeing a resurgence in their cases or a second wave. And we think a second wave is more appropriate to use for Europe than the U.S. I'll get into that why in a minute. But I think that second wave is a little bit easier if we look at the log component, so you don't see the extreme on that peak. You can see that increase. You can see the drop down, and you're starting to see that slow increase in Italy, Spain, France, United Kingdom. Now, masks are contentious. Everyone talks about the rugged individuals in the U.S., but it's not just the U.S. where there's protests because of the re-engagement or putting those lockdowns back on, as well as mandating masks. There were protests in Germany, and there were also counter-protests. There were also injuries, actually similar to the U.S. There were actually more police injuries like you had talked about last week, right? So it's not just the U.S. that has a group of people that are not very happy with some of the changes and mandates that have been put in place to try to curb these quote-unquote second waves. Now, we've pushed back against the use of a second wave to really explain the U.S., and the reason is unlike Germany or Spain or Italy, the U.S. is a very large country, and it has a lot of population densities that are really scattered across the continent. So if we look here, we can see that the first wave that they talk about was really the Northeast, New York, New Jersey, Massachusetts, as well as Washington, and I would say California really is in both of these. So it's one of the states that actually did show up here. Granted, there never was a spike up and then a drop and then a reassertion. There was just that slow, gradual uptick. They've been one of the states that have had the greatest lockdown. And then if we look here, we can see, well, here are the southern state spikes. Now, what we think is going on is the Northeast during March, April, low humidity, low temperatures. That seems to be an environment that the coronavirus 19 does reproduce well in. So that's why it showed up there. And then you're saying, well, what about the southern states? It's warm. Well, whenever it's warm, you go into the air conditioning. One of the things about air conditioning is it removes humidity and it brings the temperature down. So maybe that's the reason that there is a spike. There's clearly another narrative, right? There is the narrative that
we aren't doctors, we aren't scientists, but we're data driven. And that's what we're looking at. Is what something is causing this data.
Right, and if you look at the states, the states in the south, they never had. The one exception is Louisiana. If you remember from Mardi Gras, they did have a spike. Right. They dropped back down, and then there was a spike. So they did truly have a second wave there. But most of the states have just been on a continual upswing. So the other narrative, and it's a very compelling narrative, and it lines very much up with this graph, is, well, we did the lockdown between April and then we started to relax in June, and that's an explanation. Once again, it fits this well. But like all the narratives, every single one of them, including the one that we just threw out there are all issues with some component. It doesn't seem that anyone's hypothesis actually fits perfectly what we're seeing in the data. Here's an example. You have New York State and you have Sweden. So Sweden is one of the countries that we haven't done a lockdown in, or that a lockdown wasn't put in. We didn't do anything there. So they decided to just expect the people to make these decisions on their own. There certainly has been social distancing. There's certainly been mask wearing. But when we compare Sweden to New York State, we can see that their experience has been a lot. They have not had near the amount of deaths per capita as New York State. And in addition, if you look at who it is that died in Sweden, because they did get criticized, they did make mistakes that they have owned up to, was a lot of people in the older ages. If we take the age 70 and up, that accounts for, it's in this graph, 88% of the deaths were age 69 or above. So that's about 10% below. So they had a better experience, and they didn't do a lockdown. So once again, there's always a twist to whatever narrative we come up with. Another example would be Japan's really old, Italy's really old. Italy did so bad because of their because of the age demographics. Well, Japan didn't do bad. And people will say, well, they wore masks. Well, we knew they wore masks well before. We knew that they had a hygiene that was really, really good to stop the spread. Why is it that we expected it to happen there and it didn't happen? Another one, Iraq versus Iran. Iran has a lot of sanctions. There's a lot of poverty problems there. Iraq is just coming out of a lot of military conflict. Their infrastructure is also rough. Why is it that Iran is doing so much worse than Iraq? There's just a lot here that we don't know. When we compare, it's not just the impact on deaths, so that's certainly one of the more important impacts. There's also the economic impact. And when we look at Sweden, their approach has caused their economy to suffer less than others. However, look at Norway and Sweden. Norway did do lockdowns, and their GDP growth and projections actually look very similar. But both are doing much better than Italy or France or UK, and it's actually in line with the US for what is expected for their GDP growth. Swedish earnings, so if you look at the companies, what they were expected to do versus what actually happened, there were significant surprises. Most of the companies in Sweden on an economic basis actually fared well. So there is still this big mystery on exactly what or how this virus moves through societies. We still just don't know. Once again, every narrative has a problem that goes against it. If anybody's interested, how the moon circles the earth also has problems on every theory on why that is, and it's very interesting. So speaking of economic data, let's get to GDP. We continue, as our timeline mentioned at the very beginning, to climb out of that deep hole that we were in. So we were down 38% almost for GDP, and we're now up near 16.85% growing. Now, we know we're not going to grow our economy at that rate. We're just coming out of this deep recession that's happened. And when we start to get into the detail of those numbers, one of the reasons that we have such an uptick is big ticket items. So a lot of RVs, a lot of boats, a lot of things that are not hotels and airfare, things that you can do with your family and that you have more control of. A lot of those are being purchased, so that's actually driving up GDP right now. And if you think about it, those are big ticket items that are a one-time purchase that now everyone has to, because they're likely not writing a check for it and paying cash. They're likely taking loans out to buy them. Yes, interest rates are low, but is that pulling forward some of that consumption spending that would be driven later on in future years, bringing it forward? Likely that is the case, that that's going to slow. But they're still going to travel, they're still going to spend money, and interest rates are low. Another area that we are watching is this new construction. And it doesn't matter whether it's residential or commercial, we have 3 straight months of decline on construction spending. Now, it's likely not due to any need for money or access to capital. It's probably more to do with, do you start a project knowing that the lockdowns and states having to roll back some of the reopenings would impact a project, because labor needs to be there to do these projects. You don't want to be sitting there on idle time. Even with low interest rates, you're having to pay as you borrow for these projects. So not seeing much in the way of new construction. As we've talked about several times, so home prices continue to move up. So these are homes that are already constructed, and their price has been increasing. Speaking of increasing, let's look at government expenditures. And this is one of the reasons that we have, it feels like we're breathing in a brown paper bag half the time when we're looking at the market. But why are we staying invested? Well, it's because of this chart right here. Look at those government expenditures on that far right for the quarter. $3.4 trillion were spent over the last quarter. Now, these gray areas, those are recession components. Let's go back to 2008, and you can see that the current money being spent is dwarfing what was spent in 2008. So it is this money that is just getting into the system, despite the fundamentals of the underlying economy, that continues to say, you need to stay invested, because that money is making it into capital markets. The Fed is able to actually buy securities in the open market with all their new tools. They have not begun to actually slow those tools down. So we have continued to stay invested. And remember, this is the spending for this previous quarter. We're still talking about a $1 trillion to a $3.4 trillion spending bill. And let's say the market was to sell off. It's certainly possible. There is a lot of issues, a lot of fear, a lot of concern, especially for those small companies. My bet is it's a much closer to a $3.4 trillion stimulus bill than a $1 trillion. And the Fed's going to act. So that
never goes below the smaller number.
No, they're not going to. Well, maybe if they don't pass it, maybe that happens. I don't think that's likely. When does a politician not want to spend money? They're going to get that bill passed somehow. It's this elevated spending. And we've talked about our concerns with inflation several times. And one of the headlines that we saw from the Wall Street Journal, probably some information being leaked into the media prior to an official announcement, prior to them actually changing the language in the FOMC meeting minutes, is the Fed is going to abandon preemptive rate moves to curb inflation. Well, what does that mean? Well, that means that as the market actually starts to get traction, they're not going to wait for inflation to show up in the CPI numbers. They were going to go ahead and start moving interest rates up as the economy got stronger. They're not going to do that anymore. They want to hit that 2% target. They're happy to overshoot that 2% target to try to get an average 2%. And people can argue about whether that's correct or not. But there is a psychological component of inflation, right? And it may be that we've seen such low inflation because the Fed was quick to act and it never actually arrived. What happens if we see 3, 4, 5%? Is there some tipping point in the American consumers' psychological makeup that says, I want to buy now because I see prices that are increasing, and then it becomes really difficult to bring that inflation back in check? I would say that it's probably not a coincidence that many of the people that are making these policy changes are not the age of Volcker or even of the era of Burns, whenever they had the whip inflation now buttons. So we'll see, but what we are getting telegraphed by the Fed is they are not going to slow down the money printing, and it's likely that they would continue to monetize the debt by the government to keep these prices elevated in the market. So yes, we certainly can have a pullback in the market at this time, but most likely that would be met with, it's an old adage, don't fight the Fed. There's a Greenspan put, a Bernanke put. The Fed is going to be there to bail out because there really hasn't been any pain yet. We haven't seen inflation from this type of policy for 3, 4 decades.
Long time.
It's been a long time.
Long time.
So I think that's going to continue to be the reaction, and we do think whether inflation does show up or not, the risk of long-term inflation on your purchasing power is more significant than a short-term pullback in the market, which would respond with a lot of stimulus. And remember, our mission is
so you keep talking about 3.3 or 3.4 trillion in spending, but it's actually 3.3 or 3.4 in borrowing, because they're going to be pulling money out and then pushing it into the
well, if they were
manufacturing it. Right?
So the reason that I'm saying spending is because it's actually not technically borrowed. Americans are not giving up $3.4 trillion of consumer spending. The Fed is monetizing it, so they are creating that. It's basically allowing the government to spend money that they don't have, and it's not necessarily coming from the Treasury market by going out and getting these loans. So let's transition. The last couple of weeks we've been going on just some fundamentals on why we think inflation risks are high, why we have the investment themes that we have, why we favor the U.S. market over international. And I just want to do a quick recap. We've talked about marginal utility theory, which is really where value is derived. We've talked about the characteristics of money, what makes money good money. We've talked about the regression theorem, which is how money arrives out of the barter system. We've talked about central banking last week and how this innovation led the ability of banks to actually expand and contract the money supply. And this week we're going to spend some time on how the market works, not the banking system, not how money works, but the structure of production and the production possibility frontier. Now, these are all fancy economic phrases for what we hope really is just some straightforward.
Enlighten us with the
straightforwardness of the economy. Loss of words there. So we're going to pull some previous characters. We're going to pull that fisherman, that dreamer, the man that had a vision of a boat to go over this example. So first, let's look at the fisherman's economy, right? So we're going to imagine there are 3 stages to the economy. And that first stage, that early stage, is really the creation of some type of capital tool. So let's say in this scenario, he creates a spear. Well, what's he going to do with that spear? Well, in the second stage of his economy, he's going to go fishing. He's going to add his labor to those capital tools to try to fish. And let's say that he gets 5 fish a day because of his spear. Now, what's the point of those fish? What's the point of that spear? Well, the whole point is to consume it. And I know in modern times we will go fishing for fishing's sake, but for our fisherman here, he's doing it for consumption. And that means his labor and spending time fishing and creation of the spear all comes down to the ultimate use value, which is putting fish in his belly. So all of those capital goods, all of that labor, is all derived from its use value. So let's look at those 5 fish. We're now moving into that production possibility frontier. And what this says is, okay, we have 5 fish. We have a choice of consuming all 5 fish, or we have a choice of investing all 5 fish, and that's a really good diet plan, I guess, for him. The early boat builder fisherman was very concerned. There's always a trade-off, right? So there's some component, and in our example, we're going to say that he invests, or really saves, out of his production. He's going to lay resources aside and not consume everything. So he would fall here on the consumption versus investment. So he's consuming 4 fish. He's setting one side off per day. Maybe it's every few days his spear wears out, and he'll have 4 fish on that day that he's not able to fish and create a spear. So that's his savings that will be used for investing and really replacing the capital tools that are already in the economy. So we're now going to bring back the fisherman's economy back, where the 3 stages, as well as the fisherman, our dreamer. And remember, he had the vision of a boat. And let's say that this vision was so compelling, he's decided that not only is he going to save 1 fish, he's going to save 2 fishes.
He's going on a diet.
He is going on a diet. So what happens to our stage of production is, 1, his consumption level goes down. So he's now consuming 3 fish, and he's now saving out of that production of 5 fish, 2 fish, to help offset the need for extra days on creating that boat. But if you look at the triangle, the structure of production, it now has 4 stages in there. So that early stage now is the boat, as he goes there to construct it. Now still need to create a spear at times. Now notice that consumption, the arrow has gone down and the investment has shifted over. And let's say that he gets the boat done, it's great, it works. He now is able to produce not 5 fish, but 7 fish. Well, that means his possibility frontier, that production possibility frontier, is no longer the option of 5 fish versus 7 fish, or 5 fish to choose on consuming or investment. It's now 7 fish to make that choice. And let's say he needs to continue to replace capital. Not only does he have to replace that spear, but now he'll have to replace his boat. So now he starts to save 2 fish out of the 7. So he's continued to have that capital replacement by saving fish or setting resources aside. But remember, he has 7 fish now. That means his consumption can move up to 5. So he's actually increased his consumption, or his standard of living, by 25% in this example. So
He's doing pretty good.
he is doing good. Now let's look at it a little bit different angle. Let's look at it over time, where the y-axis is the consumption, or C, on how many fish he is actually consuming per day, and then the x-axis is time. So looking at the different spots in time whenever he's making his consumption. And he's continuing to go on, and let's say each time that he makes a new spear with the fish that he sets aside, that savings to investment, it gets a little bit better. And whenever he goes and he mixes his labor with a spear, he fishes a little bit better. And there was always this natural growth. And at some point, he was going to be producing not 5 fish a day, but 6 fish a day. And he would be able to continue to invest. So he had consumption of 5. But instead, he makes the decision that he's going to build a boat. So that means we see a drop in his standard of living. Now, one thing he could have done is just fish longer, right? And had more fish output. But that means he gave up leisure time. So in either of these scenarios, there's some type of drop in his standard of living that has to take place to invest in new capital formation. And then the boat is successful, so we can see that all of a sudden it jumps up He's at 5 fish consumption now. He's got 2 that he's setting back in an investment. But now look at the growth rate in his own individual economy. So one of the things is this showing us is one, delayed gratification. Some things that our grandparents had talked about us, the wisdom of setting things aside, because if you set a little bit aside now, you'll reap big rewards later, which starts to sound a lot like interest, right? So we're not going to get into that on this call. We're trying to keep these lectures to about 5 to 7 minutes on these concepts or these ideas. So we're going to save that and table that for next week. But you can start to see early signs of an interest show up in an economy. So back to our investment themes. Still no change, but we hope that the amount of time we've spent on what's going on in the creation of money, the monetizing of the debt, and how the government is responding, that people begin to understand why we have a concern about inflation risk. As we build this out, we'll also talk about some of the others on U.S. domestic equity, why we favor technology. As you mentioned, the S&P continues to move up. When we look at our price points, we've been in this long-term trend really since mid-April, where we've just continued this climbing that wall of worry. And as of right now, it still looks like we're going to continue to follow that trend. We have not made new highs yet in the S&P 500. At this trend rate, we could see that sometime in probably in the second half of August, based on this trend line. We all know that the market can change its mind and go a different direction. We will be monitoring that. That's one of the important parts of having that blue line there, is that trend line, and if it starts to break technically, that means a lot of people are starting to get concerned and there's some weakness. Our antennas would be up if we started to break that blue line. So we are watching this information. No changes in our asset class tilts. We've talked about and still have concerns about the dollar. It has dropped through, it's broke out of its training range, and it looks like we're going to go back to prices that on the dollar that were in early 2018. It's not a coincidence that gold is making new highs. And remember, we did add gold miners to the portfolio 2 weeks ago. So here's our relative strength. You can see gold is actually leading. It's had quite a run the last few weeks. Silver has probably had a greater appreciation. Just 2 weeks ago it was at 17. Now it's trading above $25. What else is doing well, though, is technology. So all the concerns about prices, yes, we're hitting new highs on the NASDAQ, but last week was earnings for the big technology companies. They were all doing well. We've seen a nice rally in those positions. And remember, we've given up some of our technology to try to get some mid cap and small cap exposure. Those are also doing relatively well. So what isn't doing well? Well, international markets are not doing well. We're actually starting to see commodities go up a little bit. International and U.S. domestic real estate, both of those are just near the bottom. And then U.S. Treasury bills are at the bottom. So far, our portfolios and our overweights have been exactly where we need to be. We continue to monitor these technicals to see if there's any softness, any reason to make some changes going forward. Know that we are watching this.
One of the things you were talking about was the Wall Street Journal article where it said the Fed weighs abandoning preemptive rate moves to curb inflation. And we keep talking about inflation as being the key risk factor that we're looking at. If we have inflation, what happens to equity prices at that moment?
Well, it's going to depend on what kind of stock you have. If it's a company that can easily or more easily pass on those costs or temper the pass on the price increases necessary, or keep their fixed costs low, then those equities are going to do well. If they are in a company that deals in commodities tend to do well. So the gold mining company, the cost of extracting gold out of the ground, let's say it's $600, $700, and instead of getting $1,200, they can now get $2,000, and there's really been little change on the cost. So it's companies that really have their sales going up and their fixed costs staying low that will do a great job on inflation hedging. Not all companies are going to do that, so we want to be specific, and it always reacts differently. The areas that you want to avoid are things where the cash flow is known and pretty much guaranteed. So fixed income is an example of that. And we know that, let's say, Treasuries on a 10-year is paying 0.5%, while inflation is already higher on that. And we haven't even talked about taxation or anything like that. So you want to look at securities that are going to do well in an inflationary environment. That's some stocks, that's some commodities, and others, but we also want to pay attention to our process, our relative strength measurement, because that'll tell us what is doing well if that happens.
So there's one word that is consistent when we're speaking with our clients, and that word is uncertainty. And with that, there's the fear. I just had a client today. We had our portfolio review last week, and while they're happy that things have rebounded well and they're well positioned with cash, they're still wondering, uncertainty, what should we be doing? Should we be doing something different? They've got enough cash, they have the target that we want for their cash hub. How do we handle this?
Well, there's always, you got to talk to your lead advisor one, because every person's situation is unique. And yes, there is uncertainty, but there's also a thing called equity risk premium, which is the uncertainty. Why is it that stocks perform better than bonds over the long term? Because uncertainty. You know what your cash flow is going to look like off a bond. You don't know what it's going to look like in your equity or how well a company does. So the reason that you can buy a stock and have a pretty good assurance that over the long term, especially if you have diversified stocks, it's going to do better than bonds is because of uncertainty. Now we keep talking about that wall of worry. Well, that means that there's a lot of worry. Well, why do we have worry? Because there's a lot of uncertainty. And you actually get paid with return by having uncertainty. And then what are your other options? You're going to go to cash, which pays hardly anything and is losing, especially to other currencies. Are you going to go to bonds that are losing money to inflation? They certainly will help take out some of the volatility in the portfolio. Bonds should, especially with the Fed stepping in when things start to move, and they're saying they will backstop those bonds. But it may not hold the value. And our mission, once again, is to make sure our clients become and remain financially self-reliant. And that means making sure that their assets have purchasing power over the long term. So yes, we can have that uncertainty and that uncertainty can show up as a market correction. But at least so far, the Fed has came in with stimulus packages and other things. And I don't think they're going to stop until we do see inflation.
So maybe you can talk to us more on what we're developing with regards to what we call portfolio insurance. Because we already know that our strategy will push it into the things that work and out of the things that are not working. That was well demonstrated in this last pullback, right, this last recession. But there's still that period of time when the portfolio is down. It didn't go down as far as other portfolios, but still, that's the fear that people have. So explain to us how we anticipate using this portfolio insurance concept.
Right. So one of the roles that bonds have played is actually a dual role. So it acts as a ballast, meaning that if we do get those sell-offs, bonds often don't go down as much, if they ever go down, right, during a sell-off. So there's some volatility that's removed. But the other part of that was that they don't always go down. A lot of times they go up. So you have something that is known as a low or negative correlation to equity markets. With interest rates, I use the example of about 50 basis points or 0.5% on the 10-year. How much lower can they go? They could go to zero. We've seen that in other countries. So there may still be some upside potential to bonds, but it's probably very limited. So we don't think they're going to play that role of having some upside movement in the market. They're just going to play that ballast role. So we have added to our selection and our relative strength testing, the things that we are measuring or monitoring to what is doing well, to include like hedged equity and covered calls and buying puts and long short funds and inverse funds to try to see if we can take some of those positions, maybe the fixed income, maybe the equity positions, depending on how they're ranking in our system, to try to add some portfolio insurance, because we just don't think bonds are going to play that dual mandate role that they once did when interest rates were higher and there was some cushion.
Yeah, I think that one thing that's important for our listeners to understand, it's like any insurance, it costs, right? There is a cost. So in other words, if we allocate a certain portion of the portfolio to these insurance-related products, we're really taking away from what could potentially be earned with the rest of the portfolio according to our ordinary strategy. So it's kind of a balance, but we're still in the exploratory phases of that.
Right, and the other thing
More of
that did give us a lot of protection, remember, is that technology. Because if we do have another lockdown, or we do have to reverse some of this, there's still going to be a lot of online purchases. There's still going to be changes, and those companies will probably. So there's still some downside protection if the data continues to go the other way. It's been going up for quite some time, but we have seen some numbers that have not looked as good, and there certainly is concern and fear, especially the lower you are in that market cap, the smaller of a business you are, the less you're weathering this. It's really been the story of large companies, especially those growth tech stocks, through this, through the pandemic.
So can you elaborate more on this move away from the city when the trend has actually been the other way? In fact, Harvard-educated economist Jeremiah Dent had forecast for quite some time that large homes would become white elephants as baby boomers downsized. So do you see this changing, and why?
Well, when you said Harvard educated, he's got that going for him, right?
Yeah, well, I think, he's...
It's a Cinderella story. Sorry, I had to go there. I think he was right. For the last two and a half decades, we have seen, especially the millennials, find the attractiveness of cities, and they've moved back to the cities. And that certainly was a trend that was happening. We've seen it here in St. Louis with the revitalization of Washington Avenue, which has since given back. But there's been this ongoing trend, never straight up, never moving, but it seemed to be people were wanting to move into the city. And I think that was true up until the pandemic. I think people are now looking at some of the protests that have happened, which have turned into riots in the city. They're wanting to move away from that because of safety concerns, whether justified or not. That is the belief. Also, knowing that you can be stuck in your house, it means you want a bigger house. And cities tend to have smaller living quarters, right? Especially if you're in New York City or San Francisco. I mean, the amount of money that you can collect and rent for a closet is pretty high. So the need for bigger homes, being able to have a lot of the entertainment, whether it's a home gym or a pool or other things, those are out in the suburbs. And this experience, I think, has changed the perspective of many people. Now, is it a lasting change? That's certainly yet to be seen. We definitely need cities. I think it's actually a thing that would hurt us as a culture, because culture comes from the cities. You can't have five-star great restaurants unless you have large areas of people that want to patronize that, and that means you need that networking. You need millions of people close enough to make that drive to support that.
Well, we've studied this.
We have the triumph of the city.
The triumph of the city, the fact that the city, well, you can elaborate on how that actually is good for economic mobility.
Right, and just think of St. Louis. How many times has there been pushes trying to get the city-county merger so that we can try to get, because we're a wheel and spoke, to get that center back, because everyone's out. And what would happen if everyone was downtown, all the professionals, and now they're crossing each other's paths as they do lunch? We would see a lot more vitality. So it is something to lament if that's not happening, but people are going to make changes. And if they don't feel secure and they don't feel safe and they don't feel like the school options are there, if they feel like they're a little claustrophobic and may get stuck in their homes, they're going to look elsewhere. We saw that in the 60s, 70s, and 80s. There was that reversal in the 90s, especially in the 2000s, but this may have stopped that reversal. I hope not, but so far we're seeing that trend.
Now, you mentioned that gold is on a tear, and we added some of the gold miners to the portfolio, but do we have a price target, or how do we know when to get out?
Well, we'll use our relative strength, right? One of the things that we're doing is measuring money and seeing where, what the market likes and where it's diverting assets to. So we will use that as our signal to move out. We just hit new highs, and it was above our previous high. I think it was in 2011. So it's been some time that we've had that high, and the amount of money that is being created and is expected to be created, we expect gold to continue its march up from here for some time. If inflation doesn't show up and things start to get normal, the Fed begins to have interest rates, yes, there's certainly going to be a sell-off in gold, because remember, it went from 1900 down to 1100 when inflation didn't show up and the economy started to get strong on the last. So we will continue to monitor our technicals to see that. We'll look at charting for gold. It is not a high volume asset in the way that some stocks are. So that some charting can really be informative. So we'll be monitoring that, but we do expect gold to continue up in the near term.
Now let's talk about taxes, because we've been hearing some of our clients mention they've heard that if Biden is elected as president, that he would raise taxes by up to $3 trillion, maybe even $4 trillion, depending upon what news headline you're reading. But assuming taxes do go down in the future,
Go up.
Go up. That would be nice if they went down. But assuming they do go up, should our listeners consider Roth conversions now before that increase happens?
Well, so it depends on how much they have currently in those tax buckets. We definitely want diversity across asset classes. We definitely want diversity across tax buckets. And your lead advisor, we do have programs that help us make that calculation on estimating. But one thing that I have learned is there's no such thing as a permanent tax code. It's always changing. And just as much as 4 years ago, we got a new tax code. We could, if Biden was elected 5 years from now, be looking at another tax code. So making decisions on what may or may not be 30 years from now is a little difficult, because we just don't know what the tax code would be. So it's looking at that and making those trade-offs and trying to make an understanding. Yes, the market's high. You tend to want to do Roth conversions when the market is low, but if there really is a concern about taxes, it may be a good thing. Now, me personally, bird in the hand's worth two in the bush. I'd rather take my tax deferral now and deal with it later, because there's no reason Congress can't change its mind and decide that they're going to tax Roth differently. And the tax assumptions that you use to make the calculation on whether that was right or wrong changes. I think it ultimately comes down to a discussion with your lead advisor and how much do you have in the different buckets, and does it make sense to help diversify some tax buckets so you have different sources to pull from.
So I guess that answers my next question, which is that 401ks have, of course, been an attractive way to save for retirement because the contributions are pre-tax.
And you get an employer match.
You get an employer match.
Yes.
But once you get past the employer match, especially for younger people, if they're growing in their professional fields, they expect to make more money, their tax rates can go up even higher than what they are currently. Should they continue to save through their 401k, or?
Yeah, I think they should. The tax deferral is not just exchanging your current rates for future rates. It's also the tax shelter during the time of accumulation. Every time you're making changes to your portfolio, you're not having to pay tax on that trade. And that's beneficial as well. In addition, whatever the tax rates are on the margin, especially if you have Roth and joint accounts and cash value life insurance and other places to pull from, you don't have to take it out at the top of the bracket if you have different choices. So there's a lot of tax management movement. Once again, I think the prudent way of dealing with this is having different tax buckets, because we just don't know what the tax code is going to be 20 or 30 years from now when you're making this decision. And if you're a young person, that decision is much further out as well.
Well, that is all the questions that we have for today, and that's been a great conversation. But so it looks like we're out of time. But I do want to remind our listeners that the discussions around any specific stock or mutual fund is not an endorsement to buy or sell, but simply commentary based upon each commentator's opinion. And all investments have risks. past performance is not indicative of future results. We've heard this before. So these weekly broadcasts are open to the public. Feel free to share the link to our broadcast through social media or with your friends and family, as they are more than welcome to listen in and learn our perspective on the market and the economy. Our goal here is really to be data-based. We want to help to sift through all the noise out there and give you good information so you can be confident in the decisions that are being made with regards to your own financial plans and investment strategies. So thanks again for listening in to today's broadcast. As always, if you have any questions, contact your lead advisor or any other member of the team. We are here for you.